Well, how's it going, everyone? My name is Amos, and in today's video, I'm going to be talking about which stocks that I have been buying and selling as of recently. And then towards the second half of the video, I'll be going over the intrinsic valuation for each one of these companies that we're going to be talking about here today, but also what I think is a good price to buy into them. So without further ado, let's go ahead and get into it. Now, I want to give you the bottom line up front. These are all of the companies that I have sold recently. Reason being is that I know there's people out here that are very impatient, that have the attention span of a TikTok scrolling single father of 3 kids that don't have time on your hands. So we're talking about Google, CVS, Starbucks, Visa, Five Below, and Target. And fortunately, and I'm not saying this to brag or to be like, yeah, I'm humble bragging, but I did sell out of every single one of these in the green. They were all winners. However, the thing is, I can't just make money come out of thin air, right? Unless I open up an OnlyFans account and start selling videos of my butthole and my nipples, but I don't want to stoop that low yet. Unless you do that, I'm not judging you. If you do that, do you, whatever makes you happy. But for me, I don't know. But anyways, I sold out of them because I needed the capital to buy into better opportunities that I saw in the market. And we'll talk about that very soon. However, before we do, hear me out. I know, I'm about to sound like an absolute maniac or a lunatic or weird guy. However, something that you should know about me is I'm a huge Tolkien fan. Anything related to The Lord of the Rings, The Hobbit, love it. As a matter of fact, I can watch the entire Lord of the Rings movie franchise in a single weekend, and I would consider it a day well spent. Actually, for Saturday and Sunday, so days spent well. That's how much I love the Lord of the Rings. However, as of recently, I don't know what it is. I guess I was stressed out or whatever, and I stumbled upon Warhammer. You see, I've always known about it, just never made the effort to look into it. On surface level, I have to tell you, it is absolutely overwhelming. It's kind of like the Tolkien universe, but also StarCraft, the Blizzard game, meshed into one universe. Or at least that's how I comprehend it as a guy who was looking in from the outside. And apparently there's like 2 different realms. There's like the Warhammer 40K and then the Age of Sigmar. It's a lot. I am interested. I'm like, dude, this actually looks pretty sick. So if you are someone that is familiar with Warhammer, where do I begin? Because you know everything that I don't. So if you were starting fresh right now, where would you start with Warhammer? Help me out. Okay, with that out of the way, here are the companies that I have been buying up as of recently. We're talking about Papa John's Pizza, Hershey, Realty Income Corporation, Huntington Ingalls. This is the shipbuilding company. We have General Mills, Conagra Brands, Google. Well, hold on. Didn't I just say that I sold out of Google? Yes, I did. I sold out of Google when they reached their 52-week high of about $205 a share. And I was just like, man, that's awesome. And then like a week or 2 later, Google decided to go on a sell-off and on a dip. And I was like, well, I guess I'm buying back in. So I'm back into Google. We have PepsiCo, and then of course, Nvidia and AMD. And now let's go ahead and talk about why I sold out of each one of these companies a little more in depth, and I guess I can explain my thought process and reasoning. So the first one is Five Below. And I bought into this company when they went on this massive sell-off back in the summertime. I think I bought in around right here. I didn't exactly get it at the lowest price of $71.97. I think my cost basis was around $72, $73. And then once they went on a rebound, I was just like, you know what? My conviction for this company, not the highest. I was just looking for a temporary rebound, kind of like a short-term gain story. And that's exactly what happened. After I was in the green by about 15% or so, I was like, all right, I'm cutting it right here, taking my profits and walking away. Reason being is that my initial investment thesis surrounding Five Below, it changed. So let me back it up and explain what exactly Five Below is. Five Below is essentially a retail store that kind of looks like the Dollar Tree, but also, have you ever been to the Japanese convenience store called Daiso? It's a place where you can go in and buy a whole bunch of different stuff like gadgets, household essentials, and the Dollar General. I guess it's like the Japanese version of the Dollar General. However, Five Below, they don't really cater towards selling, dish detergent or soap or even cleaning products. Rather, Five Below is the kind of place that you go into to buy cheap gadgets, toys, or gifts. And almost everything inside of the store is priced at about like $2 or $3. And so my thought process was, I think this is a really good counterplay to Temu. I felt really bullish towards all of those Chinese e-commerce websites where you can buy stuff for like $1, $2, $3. Because based on my market research, a lot of the people that were buying this random stuff on Amazon for the exact same price, actually the exact same gadget or toy, they were buying it on Amazon for like $7, $9, $10. Whereas on Temu, they were able to get it directly from wholesale Chinese vendors at like a fraction of the cost, right? $2 or $3. Likewise, when I think about Five Below, they do the exact same thing as Temu. You can go in there and you can pick up a jigsaw puzzle piece. You can pick up, action figure toys or anime gadgets, whatever it is. It's the kind of place that you go into when you just want to spend money and pick up a bunch of random crap. And the reason why I decided to revisit my investment thesis and I was like, okay, I need to just walk away from this company is because I made a mistake, right? And I think that's okay. Sometimes when it comes to these companies and businesses, I think the biggest mistake that we can make as investors is to involve emotions. If I were to fall in love with this company, Five Below, and I was like, I am never going to sell out of them, no matter what, ride or die, I just feel like that's counterintuitive to being successful in the stock market, right? And I'm not even saying that as like a professor or trying to give you a lecture. I'm just telling you as it is. You have to remove emotions. And so once I started thinking about it more objectively, I realized that I made a mistake. Reason being is that once I saw the tariff wars happening, and I think the tariff wars are just getting started as like a negotiating tactic that the current presidential administration is utilizing and leveraging in order to get better, business deals done. But for tariffs, when you think about it, who really hurts in the short run is going to be the companies because their margins are going to be slapped left and right. And when I thought about that, I was like, wait, I believe in Five Below's growth story. But if tariffs are about to be slapped onto everything that they do, because Five Below is essentially Temu, right? It's like a pop-up shop for Temu. And if Five Below is trying to sell their little gadgets and toys for like $3 or $4, but they have high operating costs and their margins are being squeezed and crushed, I feel like this company's net income and bottom line is going to be negatively affected at least for the next 3 to 4 years. So it was a company where I decided to exit in a matter of like 5 months, which is not like me. Usually I buy into a company and I hold on to it at least for like 2, 3, 4, 5 years at a minimum. However, once I was in the green and I noticed the tariff wars happening, I was like, okay, I just need to walk away. And it's okay. I made a mistake. I straight up admit it. So all that to say, if you were eyeballing Five Below, I would caution you to be careful. I feel like this company is going to be going through a lot of pain, at least for the next 3 to 4 years. So moving on to the next company, that is going to be CVS. Now, CVS is a company that when they were getting absolutely crushed, I felt really conflicted because deep down inside, when I looked at all of their metrics, financials, and fundamentals, this was a company that was undervalued beyond belief. For what they are doing and how much money they are generating, they're a cash flow machine. And they're basically a top to bottom total provider for the healthcare system. Health insurance, pharmacy, you name it. That's CVS. And so once I saw them going on this massive sell-off in the wintertime, I was like, okay, I decided to pull the trigger and I bought into CVS and I went balls deep. However, once they started going on this rebound rally, because I knew they were inherently undervalued and they crushed their earnings, for me, when I did my analysis on CVS, my forecast was that their intrinsic valuation is about $65. Once they hit that price point, I was like, you know what? I'm out. So I got out with about a 30% gain profit on CVS, which I still think very solid company. And when you look at their trading multiple, I mean, right now it's an 18, but their forward PE ratio is 11. I still think this company has a lot more room to grow. I would even argue if things keep going in their favor and they keep executing things to a T, this company probably has the potential to reach 75 maybe even $80 by the end of the year. However, for me, I felt like a crackhead because I needed the capital right there and then, because some of the other companies that I just alluded to on that list that I showed you what companies I was buying, they were going on a massive sell-off, and I was like, oh my gosh, I need the capital right now. And so I just had to sell out of CVS. I would have held on. I think this is a really good company, but I had to sell out of it. And the next company is Google. This is a weird one because not only did I sell out of them, but I decided to buy right back in. And when it comes to Google, funny enough, I've been holding this company for the past like 6 years. So I was in the green like Dr. Seuss's green eggs and ham with Google. I think I was like triple digit gain. I don't know the exact number. I think it was like 140, 145% in the green. I sold out of Google at about right here at 205. Once they reached 205, I was like, all right, I'm getting out. Because they were near their 52-week high, and I hate doing it, but I did a technical analysis, and when I looked at their 200-day moving average, and they had a line of resistance right at that 206, 207 number, for me, I was like, all right, whatever, 205, I'll be a happy camper, and that's what happened. I executed and I sold out of Google, but I did not know that I was going to buy right back into them in a matter of weeks. So funny as it is. And the next company is Starbucks. Now, when it comes to Starbucks, I still believe in their investing thesis. I truly do. I think they're one of the highest quality restaurant, quote unquote, / food stocks that are out there right now. I truly think that Starbucks, even right now with their trading multiple of a 36, I think they're undervalued with a really good brand. And when it comes to Starbucks, I was buying into them when they were going on this initial sell-off back in 2022, and they were around $75 a share. I did not get them when they were at their absolute bottom. However, I did pick them up at about $75 a share, and I held on, and I watched them rally right back up. However, once they started running into operational issues and like their revenue declining, same store sales in China is like their big catalyst in gamble. They're hoping that the China gamble will pay off, and honestly, I don't really like the idea of investing into Chinese companies, but when it comes to the Chinese consumer, absolutely bullish. I don't think you guys understand how much money the new rich in China has. These dudes are loaded over there. Of course, there's a system, right? There's a hierarchy. I would say the top 10% of China, they probably live better and spend more money than the top 10% do here in the US. And I know that's a crazy and a bold and a diabolical statement to make, but the Chinese people, even though on paper and definition they are communist as a country, these dudes are living the capitalist lifestyle beyond belief. All that to say, once Starbucks started going on a sell-off again, it's like predictable almost, right? They go on a rally and then they go on a huge sell-off as soon as any headwinds or things don't go their way, and they disclose it to Wall Street. Wall Street punishes them. I started picking up more shares right around this point at about 75. I think 75 is like my lucky number when it comes to Starbucks. So I had a bunch of shares of Starbucks. My cost basis was around $75. And then once the Chipotle CEO was announced of coming over to Starbucks, look at the rally that they went on. I held on. I was like, I'm not going to sell. Even though I was in the green by a lot, I knew that Starbucks intrinsic valuation is around 120, 130. So I held on. However, once they started going on another rally, that's when I was like, okay, I do need money right now because I need to buy into other companies. I'm so sorry, Starbucks. So I sold out of them. It's that simple. You should never feel guilty or regretful when you sell with profits, except if you're an idiot like me that sold out of Nvidia back in 2022. And I thought I was so smart. I walked away in the green with 100%, but had I just held on to Nvidia, I would have been up by 600%. So whatever, that's neither here or there. Walking away in the green, no matter how big or small, you should always smile, because I've also had to sell companies in the red before, and it sucks. Terrible feeling. However, that's why I feel a little happy today making this video. Every company that I sold in the green, and my gains were all double digits. And when it comes to like Google and Visa, that we're going to be talking about here in a little bit, triple digit gains. So I can't complain. The next company that I sold out of was Target. Now hear me out. I know when you think about Target, you probably associate them with Walmart being their competitor, but when you think about it realistically, I would argue that Walmart's true competitor and peer right now is Amazon. They are toe to toe, neck to neck, nipple to nipple on a chest. When I think about Target, I know this is going to sound off and weird. I truly think their competitor is Costco. Costco versus Target. Reason being is when you think about the demographic and customer base for Target, you're not going to see the low income folks walking into Target. Everybody knows there's something called Tar-J, right? The Target tax. You can get the same exact thing at Walmart for about 10% less. You pay more to go into a Target for the shopping experience. It's cleaner. The employees are genuinely happy to be there versus Walmart, maybe not so much. And number three, Target is usually physically located in upper class neighborhoods, or at least the middle class. Whereas Walmart, you're bound to find it wherever there's lower income folks. When I think about Target, even the rich people, I would say this is their preferred retail outlet. For the upper to the middle class area, the people that are above the median salary here in the US. Good business. I think right now they're still undervalued. However, like I alluded to earlier, there are better opportunities. So I did decide to sell out of them because they are experiencing some headwinds right now, which I think 10, 20, 30 years from now, they'll be okay. This is not a Macy's. This is not a JCPenney's. Target, I know people who work for Target in their supply chain and logistics division. This is a really solid company. They're just experiencing a little bit of, pullback from the consumers spending their discretionary money at Target. Because Target is a place, you don't go there to do your grocery shopping. You go to Target to buy new clothes, to buy new furniture, to buy cool things that you can hang up on your walls, like paintings or arts and crafts kind of stuff. Target is where that 36-year-old mom takes her kids with her to go shopping while you're at work, and she spends like $200, $300 each time. All of the other retail companies that did not invest into their supply chain infrastructure to have a transportation hub, to have truck drivers be able to coordinate regionally to drop off whatever you need within like a 12-hour drive, the ones who did not do that, dude, they're gone. They're not even here. That's why when I think about Target and Walmart, absolutely solid companies that will be very successful in the future as well. And I guess another hurdle that Target is navigating and maneuvering through is very recently, I think a whole bunch of companies decided to reverse direction, put the car in reverse, saying we're not doing this anymore, about DEI and the whole woke movement, right? Off the top of my head, there's Disney, but also Target. Whereas even like 2 or 3 years ago, Target was a huge ally of the DEI, Pride, and the LGBTQ community. However, since Target decided to say no, I'm not saying that's going to have a huge impact on the bottom line, but they're alienating both sides of the spectrum and both customers, right? You have the very conservative religious side, and then you have the LGBTQ communities. They both used to like Target. However, once they started promoting certain stuff or saying we don't promote you, then the other side gets angry. So that is something else that Target is unfortunately going to have to deal with here in the near term. And then the last company that I sold out of, this one, honestly, this is a weird love story, but I felt sad. And reason being is that Visa, one of my biggest winners in my portfolio, one of my biggest gambles, one of my biggest winners. I bought into this company. I was doubling down, going crazy. I felt like a maniac. I felt crazy because when they were going on this sell-off, I didn't see eye to eye with that. I decided to double down and I bought a crap ton of Visa. I actually timed it right. I don't know how, but I got it. I bought really heavily into them when they were around 180, 178 a share. And then I just held on. And then as you can see on your screen, they just kept going up, and they were rebounding, and they were pretty much flat as they were during the height of their, 2021 at about 248. I didn't sell. I kept holding on. I was like, I think Visa has a lot more room to go up, and up they did. Once they decided to go ballistic and reach 350 a share, that's when I knew I just had to sell and walk away. Now hear me out. Visa is absolutely one of those very few, I would argue there's probably less than maybe like 30 to 50 buy and hold companies forever. Everybody else is buy and hold, fill in the blank, long term. Reason being is that their business model or their strategy or their mission or their optics or their operations can change, right? But when I think about Visa, Solid company that's here today and here tomorrow and here 50 years from now. Very confident in saying that. So when I sold out of them, I felt like I was betraying them. It was like a loyal friend to me. Someone who allowed my portfolio to be in the green by a whole bunch. However, like I said earlier, when you sell for a profit, it's never the wrong move. However, when it comes to Visa, I felt really conflicted, but I had to do it because now we're going to be talking about the companies that I bought into and the reasoning why. And it's going to be a little more thorough and in-depth. The ones that I sold, I just wanted to kind of speed through because it's kind of like they're in my rear view mirror now. It's like, okay, well, thanks for the memories. Thanks for the kisses on the forehead, but there's someone else. And the first one that I want to talk about is Google because easily, hands down, one of the best undervalued companies available on the stock market right now. If you're one of those people that are sitting on the sidelines thinking everything is way too expensive, nothing is on sale, my friend, I don't even know you and I'm trying to tell you, Google is literally the answer. I mean, right now they're trading multiple, their forward trading multiple is a 20. A company with their hands in almost every single sector and industry involved with the internet and AI to be trading at a multiple of 20. So when we look at their revenue, look at this beautiful picture that you're seeing on your screen right now. It's basically their business segments broken down and how it's growing, kind of like a snowball, quarter after quarter, year after year. Now, it doesn't take a rocket scientist to see quickly that their bread and butter is their Google search and advertisement line of business. It makes so much money that every other endeavor or project that they embark upon is just for fun, is just a gamble. If it takes off, great. If not, whatever, because they are so profitable in their Google search line of business. I don't think you understand that Google is also the parent company of Waymo, the robo-taxi, autonomous driving technology. That is going to be a game changer. I'll talk about that here more in a second. They also have DeepMind. And if you look on your screen right now, they have a category labeled as Other Bets, $1.6 billion of revenue. And I'm telling you that Wall Street is not even taking that into account. Because if they were to think about Waymo and some of their other technologies that they're working on, like health companies, anti-aging companies, their valuation should rival that of Tesla. I'm saying that their trading multiple should be like a 200 or 300. However, Wall Street is only seeing them for what they are on surface value of a Google search business. And even then, a company where, if we take a look at their revenue picture, growing at a rate of double digits nearly every year, going from $180 billion in 2020 to what it is today of $350 billion. A company that is growing at this pace. Still remarkable and amazing. But if you were to think about all of their other bets, ventures, and projects, this company should not be trading at a 20. And that's why I'm able to sit in front of you here today and say, if you want a safe, if you want a good quality company that is undervalued, it has to be Google. And I can't say the same for almost every other company on this list, but I can say with confidence that Google is legit. This is it. Now, if you are a rational person, your next question would be, then why are they not up to the moon? Reason being is they do have some headwinds. The most important one is because of their business model and what they do, the search engine or the Android ecosystem, when you think about Europe, China, even North America, all of these quote unquote haters are labeling them as a monopoly, violating antitrust properties. I know it sounds dirty and it sounds wrong, but when I hear that, I get so bullish towards the company. If you're telling me that this company is a monopoly, then that means they are dominating the competition. That means when whatever it is that they're doing, their line of business, they are crushing so hard that the smaller fish in the pond are trying to sue them and trying to get litigation involved so that they can have a chance and have a little bit of the piece of the pie because Google is that dominant. And here's why I'm not that scared. This is not my first rodeo. So maybe 2 or 3 years ago, it happens with another high-quality compounder in the name of 3M. Now, this is a company that is involved in the industrial space, meaning they do almost anything and everything related to materials, crafts, earplugs, eye pro gear, and funny enough, even window tinting. When I used to have a car, by the way, I sold it, now I ride around on a little bike, but when I used to have a car, I got all of my windows tinted by 3M because it eliminated like 100% of the UV rays or whatnot, and I don't want skin cancer on my face. But basically, that's the kind of business that 3M is in. However, they were facing a lot of litigation struggles and being taken to court, and as a result, dude, Wall Street was absolutely fearful over this very otherwise high quality company. And I watched them, right? They went from, what is this, like 201, let's back up a little bit. That way it sounds a little more dramatic. $206 a share, they were dropping every single week. Once they started to reach this price point right here, like $100, that's when I was like, you know what? And at that moment, I think back in 2023 in June, I think their trading multiple was like a 5 or a 6. I was like, dude, that is way too low for this company. And when I looked at their financials and fundamentals for how much cash they were generating, I thought the market was just entirely unfair to 3M. So I went balls deep into them. I just kept dollar cost averaging, and then I watched my initial $100 drop even further into the red. And at one point, I mean, as you can see, it was $86. Did it feel good? Absolutely not. However, the patient investor usually wins in the end. When we're talking about a high quality company, when you start talking about a company that does not generate profit or barely makes any free cash flow and all of the other metrics and financials are negative, this is not the case. But when there's a company that is generating cash beyond belief quarter after quarter and they're going through this temporary setback, time is your friend. And that's why I love the saying by Peter Lynch, right? Anybody can invest into stocks. Smart people, people with a master's degree just like me, or even people that are stupid. Anybody can buy into stocks. However, the ones that are successful, the ones that come out ahead of others, are the ones that are able to stomach the volatility and the ups and downs of the stock market. It's not the brain that's the most important organ when it comes to being successful as an investor. It's your stomach. Can you hold on to a company instead of panic selling and saying, oh crap, I'm in the red by 15%, and then selling out of it and losing money, but rather just sitting there and being patient? The more patient you are when it comes to a high quality company, I have to say that again because I always know there's a smart ass that always has to bring up an outlier example of like, what was that one company that went bankrupt back in like the late 90s or early 2000s? Was it GE or something like that? Like, well, what about GE? It's like, dude, that's a very extreme and outlier example. So please sit down and drink some water. But when we're talking about a high quality company, with due time, if their operations are in order and they're doing the right things, they do tend to rebound, okay? And that's exactly what happened with 3M. I was patient. I just kept dollar cost averaging, and they were pretty much flat for about a year and a half, 2 years. And I was like, at the whole time, the best part about it is, when you check out their dividend profile, right? Let me show you this. They were paying me a dividend. Yes, they did have a dividend cut because they had a divestiture, or I guess they spin off, and now their consumer health line of business, which by the way, my wife loves, their pimple patches that they make. They had a spin off, so the dividend and everything else associated with it went with that company, but they paid a dividend. So while I was waiting for this company to have a rebound story that was magnificent, a Cinderella Disney movie, I was collecting rent from them while they were sitting in my portfolio. All that to say, Google going through the sell-off, I'm not worried. I'm patient. The patient investor usually comes out on top, as long as you can stomach the volatility. Now, the caveat to that is, if the company fundamentally changes and their financials start getting demolished and their economic moat disappears and their metrics start declining year over year, I don't know if time can help that situation. If it is a temporary speed bump, maybe like 2 years and 3 years of struggling, they'll usually be okay. But I do have to throw it out there, the possibility of them going bankrupt is a valid possibility. But when it comes to Google, dude, not worried. So that's my biggest conviction on this list, by the way, and that's why I wanted to talk about Google first. The next company is going to be General Mills. When we think about General Mills, they dominate the grocery aisles with foods for humans and our pets. The best brand, in my opinion, right now is Blue Buffalo. So it really depends on how you look at it, but I would say General Mills, the definition of a boring business model that is stable and reliable. People are always going to have to go grocery shopping, stock up their pantry with the foods that they like to eat, and for our furry friends. But a point that I do want to make is this is not like Google. I'm not expecting my money to 2x, 3x, or 5x. With General Mills, it's exactly like what it looks like. A very boring and a stable company that's going to be growing at a rate of like maybe 8% in the stock price appreciation year over year. And then through their dividends, an additional like 3% return. So on average, maybe like 11% CAGR year over year. Very boring, very stable. While it's on this massive dip, for me, I see opportunity. No, this is not going to make you rich overnight, but it's definitely a company where you can also hold for a very long time. And I say very long time because even though we do need food, it might not always come in the form of food that we know it today. There's a bunch of these nerds and scientists that are working very hard right now to establish and invent goo so we could just have it strapped onto our bodies and then never have to consume junk food ever again. I really hope we don't get to that point because I don't know about you, but one of the joys and beautiful moments in life is being able to just bite down in a really juicy burger, or having a slice of pizza, or putting a fat burrito right into your mouth and enjoying all the different spices, flavors, and tastes of food. I don't ever want to get to that point where all of us are just eating goo that tastes like baby food. Even though it might be nutritionally better, cheaper, more efficient, I can hear every argument and I'm still not going to listen. I would rather have my food the way it is. So please do not let that be a way of life 20, 30, 40 years from now. Can we just have our burgers be? You guys can cancel everything else. Just let me have my McDonald's burgers and my pizza and my tacos. Please just leave me alone. Even when everyone else was going like hoorah for, vegan milk made out of like bananas or oats. Dude, disgusting. I will always stick to my normal dairy cow milk. It just does not taste the same. Just let me be. Let my food be, please. But anyways, just like every other food CPG company out there, the headwind that General Mills is currently going through right now, as you can see, 1 year out, they're down by negative 9%. Inflation. When you think about inflation, that bleeds over into anything and everything, including your wife's boyfriend that has to pay for your wife's manicure. Even that's going to cost a little bit more because of inflation. So as such, General Mills, they're also affected. Their expenses to produce the goods, it's going to be higher than usual when you think about COGS, cost of goods sold. So that is their situation. It's eating into their margins. If you believe that we're going to be staying in this high inflationary environment of like 4.5 or 5% forever, then this is a company you should never go near. However, if you're anything like me that sees an opportunity to buy into them while they're on this dip because of their margins being slapped like this temporarily, I feel okay. However, I am going to make this point, not my biggest conviction. Rather, I think this is an okay company, right? A very decent investment. It's not going to be the most delicious, but it's not disgusting either. This is like right around that C plus tier ranking grade. And the next company that I bought into, Conagra Brands, ticker symbol CAG. I'm not even going to joke with you. I think I bought maybe 1 or 2 shares of it for just giggles and nipples. Reason being is same investing thesis as General Mills. They have a ton of products that fill the grocery aisles. It's a very boring business model. However, what differentiates them from General Mills is that Conagra Brands is more so associated with frozen meals that are ready to eat, not like an MRE, but things like Salisbury steak with green peas or macaroni and cheese and turkey. Let me stop myself right there. I just listened to what I just said, and that's like very weird food combinations. But anyways, they do frozen meals, but also frozen vegetables. The frozen vegetables, funny enough, is kind of like their catalyst in their growth story. They thought by acquiring all of these different snack companies, that was going to be their path to growth, but it's through the frozen vegetables. Riddle me that. And what's really funny about Conagra is that their free cash flow conversion rate right now is above 100% because of their supply chain efficiency. And let me show you this. When we go to their cash flow statement and we scroll down right here, look at their free cash flow growth. This is hilarious. This is a grocery CPG company. It's going from $600 million to, what is this, the past 12 months, $1.5 billion of free cash flow. So with that, do I see them disappearing anytime soon? A company that is this heavy in cash? Absolutely not. The same as General Mills, not my biggest conviction. I'm not going to go out there and say this is an S tier investment like Google is, but this is a solid C+. And also, let's talk about why their stock price is also being squeezed right now, just like General Mills, right? Also down by about 10% for the past 365 days. Well, their headwind is also their cost of goods are being more expensive and their margins are being hit pretty hard. In particular, this is weird. Conagra is the parent company for Snack Pack, which is a chocolate pudding that they make. Now, the ingredient that is squeezing their left titty is coca beans because they have a chocolate flavored snack pack. And right now, the price of coca beans, not a joke. At a historic high, it is ridiculous. So the margins are hurting them, but a company that is generating that much cash, financially and fundamentally being sound, I think I can sleep soundly at night. This is not a speculative company. They're literally a grocery food business. However, with that said, the next company I do have more conviction in, more faith, and I'm more bullish towards. So I will be allocating more capital towards this company. And it's Huntington Ingalls. They're in the business of making submarines, destroyers, carriers, and they have an economic moat beyond belief. Because when you think about it, the amount of intellectual property, R&D, and relationships that they have developed with the DoD that they have on hand, huge asset. Their economic moat, you just can't come one day and say, I'm going to make a submarine. I'm going to make a carrier. It just can't happen. And when the United States Navy and the United States Coast Guard needs new vessels to replace their aging fleet year after year, they can't just go to another company. This company has an economic moat beyond belief. I'm not going to say that they're the only or the best players out there, but they are the main player, and that's what's important. The market share is saturated by Huntington Ingalls for the naval vessels. That's why I am bullish towards this company. And when you think about their business model, their revenue is generated from predetermined, like a Calvinist, predetermined government contracts. Meaning, the United States government already says we're going to pay you $50 billion for this XYZ amount of ships. And then it's up to Huntington to be good on their part and deliver. And that's what I want to talk about as to why they're being squeezed right now. It's not just the DOGE, the Department of Government Efficiency, and people being scared of like contracts being reduced or eliminated. That's also there, and that's why almost all of the defense contractors are, going on the sell-off. But they're also facing another headwind issue, and it's a labor problem. Meaning the skilled hands that are making and crafting the submarines, it's in short supply because during the pandemic in 2020, quit. Almost all of them were like, we're out of here. So as a result, they had to onboard a whole boat full of new hires and they have to teach them. But if you are familiar with the construction industry, then you know that it takes time for someone to learn the ropes and then to ramp up the production efficiency. So as a result, their production output is decreased for the time being as these new hires are learning their craft. Because when you think about a veteran that has been turning the wrench for 30 years, they're going to know exactly how to do stuff their first time around. But when it comes to a new hire that's only been on the job for 6 months or 11 months, they're going to make mistakes. And when you make mistakes, you got to go back, reverse all the work that you've done so far to fix the problem and then to do it again. And when you think about all of that inefficiency, their production right now, not optimized, and that's what they're currently dealing with. However, when I think about their economic moat, but also their fundamentals and financials, I think this company, solid. If I were to give it a grade, which this is not that kind of video, I would argue Huntington Ingalls should be a B+ or A-. There is another defense contractor that I think is A+, S- tier, and that one is Lockheed Martin. Unfortunately, I have not been able to pick up any shares because I am waiting for their price to reach my buy price. Next company that I have been buying up is Nvidia. Their GPU chips are at the center of the AI gold rush right now. With that said, did you know that the new Nintendo Switches that are about to come out, they're supplied by Nvidia chips as well? So their chips are not just for the AI movement, it's in all sorts of different gadgets, equipment, and computers. Nvidia is that company. So when I think about the AI chips space, it's the exact same way that our grandparents, back in the 1800s or early 1900s, how they viewed oil. AI chips is going to be a super important ingredient for the next boom in our economy. Because going forward, our economy is going to be predicated upon how efficiently can we do things. If we can automate stuff away, if AI can replace the duty and responsibilities of a human, they're going to do it. And when I think about it, that scares the living crap out of me. Can you imagine one day we wake up in 2037 or in 2041 and there's going to be RoboCops just roaming the streets and you do one thing wrong by mistake, like you're eating your Costco hot dog and you trip and you drop it and it's considered littering. And then one of these RoboCops like laser beams right into your thigh and arrests you. Like, dude, that's going to be a scary future. Hopefully that never happens. But the fact of the matter is AI is never going away. If AI has an ability to automate or make your job more efficiently, it's going to do it. Hopefully it doesn't replace all of us, because that's a scary future to think about as well, right? When you think about a robot, doing whatever it is you do at work, if you are a surgeon, if you are an accountant, if you are a crossing guard, can you imagine the robots taking all of our jobs? Dude, that's terrifying. It's like that one movie, what is it, with Will Smith and his dog? He's like one of the last humans alive, and there's a whole bunch of robots taking over. I don't know. When I think about the hypotheticals, it gets kind of scary, right? I don't know. There's going to be other people that are going to be worshiping robots because they're going to be like, dude, these guys are awesome. They're so cool. But for me, I kind of see the scary side of it. And when you look at the valuation for Nvidia, as a value investor or as someone who has a very low risk profile, you might see their PE ratio being at 35, their forward trading multiple. Because when it comes to growth companies, you shouldn't really look at their current metrics because they are priced in for their future expectations of what they're going to do in the future. So it's more appropriate and accurate to look at Nvidia by their forward PE ratio. Looking at it and saying 35, it looks expensive, right? However, what I want to show you is, check this out. Their revenue broken down by business segment. Look at the growth. This is not a timeline of 10 years or 20 years. This is quarter over quarter. So going from 2021, look at this, data center revenue. This is what they refer to as the AI chip space, $8.2 billion. As we fast forward, look at what happened to the data center revenue. $98 billion in revenue, and that's just for the data center space. So this is a company that is backing up those numbers, that high valuation, and delivering, and they have the fundamentals and the financials on paper right now to justify a 35 PE ratio. So if you feel a little hesitant about Nvidia, hopefully that calms your right nipple, because I know that's the one that gets anxious and worried all the time, whereas the left one is the crazy one that says, just do it. That's the reason being. And when we look at their income statement, if you want to look at it more black and white, fiscal year 2020, they generated $10.9 billion. Look at, as you fast forward, look at the growth of their revenue. This is bonkers. This was a hiccup year, 2023, and only went up by 0.2%, meaning $26 billion year over year was pretty much flat. But then look what they did after that. It went up by 125%. And then for the past 12 months, now we're talking about 152% growth in their revenue. That is absolutely wild. And that's why Nvidia is also one of the companies that I have very high convictions for. Faith, meaning I believe and I have confidence in this investment. This is not one of those companies where I'm going to be like, oh my gosh, am I in the red? Is it going to go up? This is a company where I can buy into, go to bed. I don't know, maybe I'll get into a car accident and go into a coma for 10 years. I'll wake up and the first thing that I'll do, probably take a piss, because after you not pee and being in bed for 10 years, you'll probably want to pee. But after I pee, I'll open up my investment brokerage app and I'll look at the price for NVIDIA and I'll be a happy camper. This is one of those companies, 10 years from now, you're going to look back at this little dip and you're going to be saying stuff like, why did I not buy into it? That's how much confidence I have in this. It's not up there with Google. I feel like out of this entire list, Google is the one where if you were a family friend, you were asking me like, hey man, I've got like $5,000. I don't really need it for the next 3 years. Where should I put it? I want it to grow as much as possible in a safe manner. I wouldn't recommend a treasury bond note or even putting it into a CD. No, I'd be like, dude, just put it into Google. I have that much confidence in Google. That is my S tier, safe, undervalued, high quality compounder. NVIDIA though, close second. I would argue probably something like an A minus. And the reason why I can't bump them up into the S tier is because they didn't pay me enough. They didn't promote me. They didn't sponsor this video. No, I'm just kidding. Is because the AI space is rapidly evolving. Every single day, new developments come out and it's changing at a pace where even Wall Street and people like you and me were like, what the hell is happening? Because of that, next week or even next month, a new technology or a chip space maker might overthrow NVIDIA for what they are doing right now. However, do I see that really happening? No, but I'm just throwing out the possibilities. That is something that I do need to entertain, in the back of my mind. Such as whenever my hair gets this long, there's this annoying voice in the back of my head that's like, just shave it, just buzz it. I don't know why, right? It's that masculine urge of like, I just need to buzz my head. For all we know, in the near future, Google or even Apple or Amazon, from their own in-house technology and the chips that they're doing, they might be able to be the AI chip space leader. I'm not saying that's going to happen, but I'm just throwing it out there as a possibility. This is some stuff that you do need to entertain. But for the time being, NVIDIA is the king. So if they are the king, then who's the queen? Well, we're going to talk about that next. However, what is the headwind that they're experiencing right now? Like, why are they going through the sell-off? I guess not anymore. They recovered. That's the thing. When it comes to NVIDIA, whenever they go on a sell-off, if you need a sanity check, you just need to zoom out. Well, I guess 5 years is it just shows you their explosion. But if you just zoom out past 1 year, whenever they go on a sell-off, they almost immediately recover. It almost gets too easy when it comes to NVIDIA. Like whenever you feel like you're in doubt and they go on a sell-off, if you just don't open up your stock market app for a week or two and you check again, you'll be flat. Like despite the fact that it just went on this sell-off. And it just happens again and again. But the best part is, in the grand scheme of things, even though they always tend to recover, they find a way to reach a new high. So that's NVIDIA. But what is their headwind? Why did they just go through their most recent sell-off? Unfortunately, when it comes to NVIDIA and all of the other AI chips businesses, any concern, any speed bump, or any headwind is enough to trigger a massive sell-off, which is kind of annoying. So definitely I would not recommend going into NVIDIA if you cannot stomach volatility. This is not a safe and steady ride like, for instance, a boring company that always seems to be reaching a new high like Walmart. Walmart is a company where you do not need to have a strong stomach. You could even be a ooga ooga ape. Put money into Walmart. Wake up 5 years from now and be like, ooga ooga green. That easy. But NVIDIA, yes, you're going to be in the green, but in between the start and finish, there's going to be dips and volatility beyond belief. However, the good news is, in the grand scheme of things, their performance, their CAGR, their total return, nothing short of beautiful. So what is their headwind? Oh my gosh, I keep getting sidetracked. So their headwind right now, their most current one is China and their claims to develop AI models using less powerful chips. Because NVIDIA, their growth story is based on how they are able to create a GPU that is more advanced and powerful than the one before it, so that you can create a more complex and diverse and complicated learning model with AI. However, China is saying, we actually don't need that. We could achieve, what was it, DeepSeek? With the budget-oriented ones. And so investors on Wall Street were like, oh my gosh, So you're saying, hold on, stop right there. So you're saying you don't need to buy the most expensive ones and you could just buy the budget ones? Now we're just gonna sell out of NVIDIA. When that was happening, dude, I got greedy. I turned into a monster. I started selling everything that we talked about earlier, like Visa. Oh, I really wish I didn't sell out of Visa, but I had to. And I decided to buy into NVIDIA. Like, let's talk about that right here. So NVIDIA, they were going on this massive sell-off. They reached 117 a share at one point, or as you can see, 116. I was throwing money faster than I could. I was like, oh my gosh, I'm just gonna keep buying. I don't know what's gonna happen, but I'm gonna keep buying. I'm just kidding. I did my investment thesis. I did my homework, my research, and I reached my own intrinsic valuations. And I was like, dude, NVIDIA is not worth 117. It is worth so much more. I'm going to continue buying it. But for comedic purposes, I was like, I'm going to keep throwing money. Just shut up and take my money. And look what happened in a matter of 5 days. They're up by 5%. And when we talk about their lowest point to what it is today, which is where I started dollar cost averaging and I was throwing down money, well, just stock price appreciation alone, it's up by 19%. Most investors in the stock market, they're happy for a 1-year period of investing or holding onto something to get a 10% return on investment. In a matter of 2 weeks, this stock went up by 19% just by buying the dip. That's why I say it's almost too easy when it comes to NVIDIA. So that almost begs the question, so why don't you just do short-term trading with NVIDIA? Buy the dip, whenever they recover, 20% in 2 weeks, sell out of it, wait for the next dip. And I'm gonna be honest with you, I never really thought about that until now. I started talking about it and reflecting. This is me on the spot, just thinking about it. I'm like, that's actually not a bad idea. But that kind of goes against the whole idea and premise of being a long-term investor, of holding on and waiting for the bigger growth story. Because if you're happy with the 20% gain, you might miss out on the 600% run-up in the next year, 2, 3 years. Because just because it happened in the past, it doesn't mean it's going to happen in the future. So just because it happens to go on a dip, it doesn't mean it's going to recover the same way it did to go on another dip. Does that make sense? And that's what happened with me in 2022. Here, let's just zoom out so I can show you what the heck is happening. So I bought into NVIDIA back in like 2017, 2018, something like that. So I basically sold out of NVIDIA prior to the stock split at about 24 bucks a share. Now, had I kept playing that game of buy the dip, sell the rebound rally, look how much I would have missed out on if I did not time it perfectly to the T. Look at this. I would have missed out on a 472% gain. Return on investment if you were to just buy and hold. Because when you want to try to play timing the market and you want to just time the dips perfectly and the rebound rallies perfectly, you might not be able to. So maybe that's my answer to why I don't do that methodology, but I don't know. It is something that I'm going to be thinking about when I sit on the toilet later. I'm going to be like, why don't I do that? That's actually not a bad idea. The next company is AMD, Advanced Micro Devices, also known as Advanced Money Destroyer. Unfortunately, I am a bag holder, but I don't feel too bad about it. This is a very high quality company with, here, you know what? Let's let the numbers do the talking. When you take a look at their revenue year over year, fiscal year 2020, what? What does it say, Jimmy? It says $9.7 billion. Phenomenal. What is it for fiscal year 2024? $25.7 billion. Oh, okay, but that's just the revenue. What about their free cash flow? Because we want to know, is the business generating cash or not? Are they profitable? Well, when we look at their free cash flow, $2.4 billion. Financials, fundamentals, look phenomenal. This is the queen to the AI chips business right now. Some people might argue Broadcom is, but if we're going to be honest with one another, AMD is the queen and Broadcom, I would argue, is probably the mistress. They're coming up. They're up and coming with their custom AI chips. But AMD, as of right now, February 2025, they are the queen and player number 2 for the data center AI chips. They're soon to be player number 1 in the PC CPU space. Intel, bye-bye. AMD is taking up their market share and they're finally, oh my gosh, we have to praise Lisa Su. They're finally establishing commercial relationships with Dell, HP. These are PC companies that used to have a monopoly with Intel. They barely gave any contracts or allocated any laptops for AMD CPUs, but now they're realizing like actually AMD is superior. It's more cost efficient and it runs way better, and their company is not all sorts of jacked up. So we're going to work with AMD now. Intel, dude, their story is not good. However, if you did buy into the Intel dip when they reached like 17 or even 18 bucks a share, and now you're witnessing the rebound rally because of the rumors of a buyout or them selling parts of their business, are they going up into the green because of their financials, because they're crushing it, because their products are good? No. They're going up because people are saying, oh, there's finally a life vest. We're drowning in the ocean right now, but there's a life jacket for us to be saved. So when you think about Intel, they're going in the green right now, a temporary rally because of rhetoric and speculation of someone else buying out their business or them selling their foundry business. It's not because of what they are doing and because they're so amazing. Actually, let's follow up on that. I know that they went up to like 26 bucks a share the other day. Today, they're down by negative 6%. But if you look at the past 5 days, they're up by 22%. This is a company that I would not touch because when you think about their fundamentals and financials, but also their products, trash. Not good. Even though they're trash, I mean, it is kind of crazy to say that Intel generates $53 billion of revenue. For a company that I would categorize as a dumpster fire, I thought their revenue would be a lot lower, but that's a pretty impressive top line if we're going to be honest. But what I do want to point out is when you look at January of 2022 and you look at that dark colored blue right there, client computing, that's their CPUs, $40 billion. But look at what happened since then. They have just been losing market share, and now they're down to $30 million for their CPUs. However, what has been going their way is the foundry services, which I think is pretty hilarious. What's crazy about Intel is when you look at their book value per share, it's $22.93, and this company is right around that mark. So this company, Wall Street does not like. A lot of people are fearful around this company, but I think fearful for good reason. I genuinely do not believe in their turnaround story. Now, if you are a shareholder of Intel, please don't click dislike. Hear me out. I think this company in the past was a beauty, was a delicious compounder with cheese. I think, unfortunately, when I think about all of their lines of business, dude, the competition has just... They're taking market share and they're not giving Intel a chance to breathe. It's like putting someone in a chokehold, in an MMA fight, and Intel is tapping out and the guy's just not letting go. When we talk about the CPU space, dude, AMD. When we talk about the GPUs, NVIDIA. When you talk about their foundry business of them manufacturing chips, TSM. I mean, last I saw, TSM is building out factories here in the US to build out chips. That's how little faith we have in Intel for them to be able to execute and to build out chips on a large scale that TSM does. Because TSM is doing it, they're the best in class and they are the standard. So why not just work with the standard rather than Intel that's kind of like working through it and trying to learn how to be, efficient. But in all honesty, I hope it works out for you guys that are invested into Intel. I genuinely hope TSM makes an announcement like, you know what? We're going to buy Intel, the pretty and the ugly. We're going to buy it all at an average price of $40 per share. Something like that happens, dude, I would be happy for you. As for me, I'm not investing into them. But anyways, jumping back to AMD, 1 year out for the past 365 days, they are down by negative 34%, which is pretty bonkers. And that's why even a guy like me, who believes in the philosophy of value investing, once I started digging into their numbers and looking into their fundamentals and assessing their future prospects, I came to the conclusion that AMD is absolutely undervalued. However, why are they suffering? Why are they not in the green like NVIDIA? Well, the headwind that they're experiencing right now is there is a narrative that is going around Wall Street and around other investors that NVIDIA is going to dominate the AI chip space to the point where nothing is going to be left for AMD. However, let's let the facts speak for themselves. I think AMD is misunderstood. Case in point, when we look at their revenue broken down now between you and me, the only business segment when it comes to NVIDIA, AMD, Markel, and all these other AI chips manufacturers, the only one that they truly care about is the data center space. Now, in June of 2021, the data center space made up $1.4 billion. But look at what has happened since then. In the past quarter, their data center generated $12.5 billion of revenue. However, I do have a call out that is kind of concerning because when you think about their gaming revenue, it is declining year over year, right? Because when you look at September of 2022, it generated just shy of $7 billion. But since then, it's just been declining, a slow and an inevitable death, which is not good. And then the embedded space is the exact same story. Stuff that's in our cars, equipment, whatever, stuff that does not go into a data center or a computer. That's also declining. So when you think about it, those two segments are declining, but the data center space is increasing. So it's kind of growing, but not at a rocket ship pace because of the two stuff that's holding down their ankles. So that is a little concerning, but I think AMD, they're making a strategic bet that the future for them and the revenue and their operating is going to be centered around data centers. So it is a little weird to see them kind of abandon the ship for gaming. They haven't completely let it go, but to allocate all of their resources and talent and research for data centers, I guess we'll see, right? This is a very strategic bet that they're making, and maybe in the future it'll pay off. Maybe it won't. However, overall, I am bullish on this company. I think their numbers and financials, they look really freaking phenomenal. Now, for a company that is operating at the tip of the spear with NVIDIA to have a forward trading multiple of a 24, dude, I think the numbers speak for themselves. Absolutely undervalued. This is a really good company. Now, with that said, if NVIDIA was an A plus tier, I would categorize AMD as like a B minus to, on a good day, maybe a B plus. They are player number 2 in the AI space, but I feel like there's still enough pizza slices to go around for them to eat as well. AMD does have a pretty respectable chunk of the market share for data center chips. It's not like NVIDIA has 100%. The next company is Hershey, ticker symbol HSY. And for the past 1 year, they are currently down by negative 14%. And I have been buying them on this dip right here and right now because when it comes to Hershey, they are one of the more premium CPG companies. Meaning, right now, their trading multiple being a 15 is uncharacteristic of Hershey. They usually trade at a premium because financially and operations-wise, they're probably one of the better run CPG companies out there. However, when that gets taken away, then what happens? And that's why this company is suffering right now. Let me back it up a little bit because you might not know what Hershey does. They're in the candy and snacks business. Because all I'm trying to say, it seems like every single month, there's a holiday that necessitates the sale of candy. When we talk about Valentine's Day, Halloween, Hanukkah, Christmas, Easter, every single month, there's a reason why Hershey's candy is needed beyond the usual snacking. So the investment thesis for Hershey, I think, is absolutely hilarious. However, they are experiencing a headwind right now. When we talk about the pandemic, inflation, and supply chain issues, I think I alluded to it earlier. The ingredient that Hershey uses the most is chocolate. And the prices for raw chocolate, the cocoa bean, is at a historic high, which means for them to sell a chocolate bar at $1.99, and let's say usually they have like a 50% operating margin, because of the cost of cocoa being so high, it's being crushed down to around like 15%. I'm pulling those numbers right out of my butthole, but I'm illustrating what exactly is happening to Hershey right now. They're otherwise a very high quality company. Case in point, when I pull open their financials, we look at their income statement. When we take a look at their top line, remarkable, reliable, steady. But here's what I want to show you. Even though their margins are being crushed beyond belief, when we take a look at their net income, look at how it's growing by double-digit rates year over year. That is absolutely bonkers. And when we take a look at their dividend profile, a 3% dividend yield, payout ratio being 50%, sustainable, the growth rate sitting at a 14%, what's not to like about this company? Are you one of those fanatic believers of Ozempic? No one's ever gonna eat chocolates anymore. Dude, just walk into your local Walmart. Take a look left and right. Does it look like the population of the US is getting healthier and thinner? Or does it seem like we're getting fatter? I think statistically we are losing weight as a whole, but the idea of junk food and our infatuation for it disappearing anytime soon, not happening. Dude, chocolates, it's here today and it'll be here tomorrow. So for Hershey, it's a pretty easy decision for me to just buy the dip, not sweating too much with this one. Now, if this was a very speculative company that was not turning a profit, did not pay a dividend, and their financials were shaky, yeah, I would be sweating. But a high quality company like Hershey that is currently navigating through a storm that they have navigated past dozens of times in their company history, I feel okay with this one. I feel pretty confident about Hershey. Yes, this dip is a little alarming, but I genuinely think 3 to 5 years from now, I'll be smiling. Hopefully I can say, I told you so. That's not my personality to shove that into people's faces, but deep down inside, I'll be celebrating. Once they rebound and rally back up to like 220, 250 a share, I'll be a happy camper. Let's move right along to the next company, and that's going to be Pepsi. Are you starting to see a trend? I truly believe that the food CPG companies are on a dip right now and they're undervalued, and I think it's a buying opportunity. Because now we're talking about Pepsi. They're in the business of beverages and snacks. Very similar story to General Mills, Conagra, and Hershey. Inflation is just grabbing a piece of their side fat, like right there, and it's just pinching them. It's hurting them right now. The cost of goods to manufacture, to pay for your human capital, just getting everything rolled out costs more than usual, so their margins are being hit. And to be honest with you, Pepsi is a company that has been on my watch list for the past 5 years. However, they always traded for a premium where I was like, dude, I don't feel comfortable overpaying for a good business. Because it's not just buying into good companies. You also have to pay a good price, meaning a discounted bargain rate when you get that good deal. That way you can walk away with a smile on your face like, yeah, dude, I just got it for 20, 30, 40% off. But to buy it at its intrinsic valuation, I always just felt like it's not a good deal for me. So I just was patient. Finally, after waiting for this long, Pepsi is finally at a discount and I feel happy about it. And that's why I'm buying into it. And I feel a little weird, like an unhealthy relationship because they keep going into the red and I just keep buying more. So I don't know. I could be an idiot. Maybe they'll go further into the red and I'll be bag holding. But a quality company like Pepsi, I feel like we'll be okay going forward. I mean, just look at their top line situation and their free cash flow being $7.1 billion. What's not to like about this company? And they've been growing their dividend payout for 53 years, a 3.7% dividend yield. Too much to like about it. It makes too much sense to me. I would rather you not buy into it so I can just buy more. No, I'm just kidding. I love Pepsi. I think Pepsi is one of those companies where 5 years from now, I'm going to be super happy that I decided to keep dollar cost averaging. Well, I guess we'll see. Time will tell. And the next company is going to be Papa John's Pizza. If you can't tell by the name of their business, yeah, they do pizza. However, I will throw this out there. They do not have an economic moat against the competition. When we talk about Domino's, Pizza Hut, Blaze, or even Little Caesars, they do not have an economic moat. However, what Papa John's does have is a loyal customer base. People that will only eat from Papa John's. Believe it or not, there's some people that prefer their crust or how sweet their tomato sauce tastes. Because I'm going to be truthful with you, in the pizza space, I genuinely believe that Domino's is number one. However, in the context of Papa John's, I think they're an easy number 2 or number 3. So it's kind of like Domino's is Nvidia and Papa John's is maybe Broadcom, depending on how you want to look at it. Which is to say that it's not a bad business in the pizza space. They're solid. Their financials are okay as well. Fiscal year 2019, they posted $1.6 billion. And as you fast forward, it was growing at double-digit rates. However, when a box of pizza, a large with like 2 toppings costs like $34, yeah, people are not going to order pizza as much. However, the fact of the matter is, people love their pizza. They cannot get enough of it. And as you can see, they just posted $2.1 billion in the past 12 months. So there is growth happening, but not at a rate that makes you feel super confident. Unfortunately, worst case scenario, next year, they might even be flat at $2.1 billion to find a way to increase the top line. I think that is crucial. If things don't change and the cost of production and tomato sauce and cheese and the flour to make the dough, if they don't come down, their net income, yeah, it's gonna hurt them. This past fiscal quarter, they posted their best day of sales ever in company history during Halloween. So I think they have it in them, that growth Cinderella story of being right up there with Domino's. But as of right now, it seems like the people would rather pay less and just go to Domino's instead of paying more and going to Papa John's. So I will say this, it's not my biggest conviction, but Papa John's, I think it's an easy investment for me. Not the highest quality company. I think it's like a C+. I'm not going to say it's ugly because I really don't think their profile, their financials and fundamentals justify something like a D or an F. This is a company that I think is slightly above average. And the best part is they pay a stable dividend that is growing, 3.7% dividend yield, sustainable, and they do share buybacks. This one I would not recommend anyone to follow me into. As a matter of fact, I wouldn't recommend anyone to follow me into any of these companies. But Papa John's definitely do not follow me. Last but not least is Realty Income Corporation. If this is your first time hearing about Realty Income, I'm concerned because I feel like I talk about them so much, but they do commercial real estate. It's a very high quality real estate company that I would argue sets the standard for what is an S-tier REIT. Their AFFO growth, their balance sheet, and their dividend profile speaks for themselves. An absolutely beautiful business. I mean, their trading multiple right now is at 13.5. You can think of this as like the PE ratio. When we talk about their dividend profile, a 5.6% dividend yield that pays out every single month, and they're growing it for the past, 27 years, according to this AI-generated chart. And their AFFO per share, amazing. Just look at this. This is beautiful. This is essentially the REIT's equivalent of free cash flow. There's a lot to like about this company, and it's one of those where whenever it goes on a dip, just like Nvidia, it's hard to say no. Likewise, when my Tottenham Hotspurs are down like 3-0 and it's at the 87th minute mark, I just can't stop watching. The pain and the misery, I enjoy it. By the way, I think their turnaround story is about to happen because all of the injured players are finally trickling back into the squad. However, I will say this season has been kind of in a roller coaster of an emotion because at one point, we were in the relegation zone. And I don't think the Spurs are 100% safe yet, but I think we're okay for the time being. I think any chances of landing in the top 5 for the Premier League is over for the season. However, I do hope that Ange puts all of the eggs into the Europa League Cup because I think we genuinely have a shot at winning the whole thing. Anyways, now let's go ahead and talk about what price that I have been buying into these companies for and what I believe their intrinsic valuation price to be, meaning 6 months from now, or even like 2 years from now, what price should they realistically be trading for? And I categorize them into 3 different brackets. There's a rebound, which I think is kind of risky because that rebound might not never come. And then there's also the buy and hold, which I think is fundamentally a good company, high quality, and it's a pretty safe investment, at least it is for me. And then there's the growth category. So with the rebound businesses, between you and me, I think I only have like 2 shares of Papa John's, 2 shares of General Mills, and maybe like 1 share of Conagra Brands. However, on the flip side, with the buy and hold category, that's where I'm going gung-ho, like all out. And then with the growth companies, instead of the vision of holding on to them for the next, 20 or 30 years, for me, once I have a pretty big unrealized gain, I'm probably gonna sell out of them. So whether that's gonna be a year from now or 3 years from now, that's the game plan. I think out of this entire list, the easiest yes for me is Google. Anything under $182, I think that's a solid deal. And then another one that I think is a really good deal right now is Huntington Ingalls. And I say that because on the conservative, lowballing estimation, their fair price should be around $250 a share. Once they can get their labor issues in order, $250, not too crazy. I would even argue $290 to $310 is realistic for Huntington Ingalls. And something else that I want to call out is Nvidia. I did not put a fair buy price for them. Based on what we are witnessing for Nvidia, I feel like buying them on the dip, whenever they go like 5% into the red, they're at like 127, 125, might not be the worst idea in the world because, okay, I'm going to say it again. Past performance is not indicative of future gains, and what happened in the past may not happen in the future. But whenever they do go on a dip, they always seem to find a way to rebound and rally back up. With that said, for me, my cost basis for Nvidia is below $119 a share. So I think that's a really good price to get them at. However, buying them on the dip, not the worst idea in the world either. And with all of that said, just the other day, I uploaded my life and investing story video onto the internet. And I'm going to be honest with you, I have not mentally prepared myself to check or monitor the comments because it's a strange and weird feeling to just put yourself out there onto the whole internet and to just show your authentic and genuine self, right? To show and share your life story is kind of intimate, right? It's kind of raw. So to be honest, I'm a little nervous as to what the comments are going to say. But that is on my agenda tonight. After I am done filming this video, I'm gonna check out the comments, read, maybe smile, maybe cry, maybe laugh. But anyways, those are the stocks that I have been buying and selling as of recently. If you made it to the end of the video, I love you. Stay safe and good luck in the stock market. I'll talk to you guys really soon. Peace.